Welcome to the deep dive. Today, we're exploring a topic that many of you have asked us to look into, the financial future of aging parents. It's a natural concern, I think, especially when tools like reverse mortgages get mentioned. For a lot of us, honestly, the very phrase reverse mortgage can bring up more questions than answers, maybe even some anxiety. So we've gone through the material you've gathered on this topic, all your sources, and our mission today is really to unpack it all. We want to pull out those, crucial nuggets of knowledge so you can walk away feeling clear, confident, and genuinely empowered to handle these important family discussions.
That's exactly right. We're going to dissect what a reverse mortgage truly is, weigh its potential upsides against the very real risks, and most importantly, I think, equip you with the insights needed to have those open, informed talks with your parents. It's really about understanding the whole financial picture and supporting their long-term independence.
Okay, let's dive into this. So let's start with the absolute basics. When someone hears reverse mortgage, it can sound a bit like, I don't know, financial jargon. What exactly is it? And how does it fundamentally differ from a traditional mortgage we're all, pretty familiar with?
Right. Well, at its core, a reverse mortgage is a type of loan. It's specifically designed for homeowners age 62 or older who have significant equity built up in their home. Think of it this way. A traditional mortgage, you borrow money to buy a home, and then you make payments to the lender each month. A reverse mortgage is sort of the opposite. You borrow against your existing home equity, and the lender actually pays you. You don't make monthly mortgage payments back to them, and crucially, you keep ownership of your home.
Right.
You still hold the title. It's basically a way to turn that stored home value into cash you can use without having to pack up and sell.
That's a really key distinction, getting paid,
Yeah.
not paying.
Hmm.
So, okay, if my parents meet that age requirement, 62 plus, and they've built up substantial equity, what's the primary motivation for them to even consider this? I mean, what problem is it genuinely solving for them? Maybe beyond just more money.
Yeah, good question. The main driver is often about finding financial flexibility and, frankly, security in retirement.
Yeah.
A lot of older adults find themselves in that situation, sometimes called house rich but cash poor.
Right.
They might have this valuable home, maybe paid off over decades, a huge asset on paper, but they don't necessarily have enough liquid income, enough cash on hand to maintain the lifestyle they want or cover unexpected things like medical bills or even just fund necessary home repairs. A reverse mortgage can bridge that gap. It provides that cash flow to, improve their quality of life and maybe reduce some financial stress as they get older.
As I was looking through the materials you sent over, one thing really jumped out at me, and it kind of surprised me. It was the incredible flexibility in how these funds could be used. It's not like a car loan or even a student loan with the set purpose. What does that flexibility really look like in practice? And what are some of the common ways, or maybe even surprising ways, families actually use these funds?
That flexibility is precisely what makes it so attractive for many people. The funds are incredibly versatile. Think of it almost like an open line of credit secured by the home equity. Your parents could use them to cover, say, rising medical costs, which, let's face it, often become a bigger factor as we age.
Sure.
They could use it to supplement their monthly retirement income, just to have a bit more breathing room, ensure they don't have to cut back on essentials or things they enjoy. We also see it used quite a bit for renovation projects, especially those aging-in-place modifications.
Ah, like grab bars or ramps.
Exactly. Wider doorways, maybe a walk-in shower, things to make their homes safer and more accessible so they can stay there longer. Or it could be for something like consolidating existing debts, maybe high-interest credit cards, which can really simplify their finances and lower their monthly outgoings. And what's really fascinating, as you pointed out, is that the sources mention some people even use it to fund gifts for their heirs now while they're still alive.
Wait, gifting for heirs now? It sounds counterintuitive if you're pulling equity out of the home that might eventually become inheritance. What's the thinking there? Is it about seeing the impact of their generosity directly, or is there some other financial angle I'm missing?
It's a really interesting point, isn't it? Sometimes it is simply about the joy of seeing their children or grandchildren benefit from the funds while they're still around to witness it, rather than it being just a number in a will. Other times it might be a strategic move to help heirs with significant financial needs earlier in life, maybe for a down payment on a house or education, when the impact could be greater. And in some complex situations, depending on the overall estate size and planning, it could even potentially help offset future estate taxes, though that's more niche. But yeah, it fundamentally shifts the focus from a future legacy on paper to a present-day impact. And the lender can structure how they receive these funds too. It could be regular monthly payments, one big lump sum up front, a flexible line of credit they can draw on as needed, or even a mix of those. It's tailored.
Okay, that makes more sense. Now, while the idea of accessing home equity without selling sounds, incredibly appealing on the surface, it's totally natural for adult children like our listeners to have concerns. One of the biggest fears I hear again and again is about parents potentially losing their home. Can you tackle that head on? Is that a realistic risk, or is it more of a misunderstanding of how these things actually work?
This is such a critical point, and it really needs to be crystal clear. That fear of, immediate foreclosure or losing the home is often and thankfully overstated.
Yeah.
It's largely a misconception. The source material is very, very explicit on this. As long as your parents continue to meet the loan requirements, which means living in the home as their primary residence, maintaining the property reasonably well, keeping homeowners insurance active, and this is crucial, continuing to pay their property taxes.
Right.
As long as they do those things, they cannot be forced out just because they have a reverse mortgage. The loan itself doesn't mean they give up ownership. They still hold the title.
Okay, so if I'm hearing you right, that protection really hinges on those conditions. Live there, maintain it, pay taxes and insurance. Got it. But if they can't be forced out as long as those are met, when does the loan actually need to be repaid? Because, it can't just go on forever, right? There has to be some point where the lender gets their principal and the accrued interest back.
No, absolutely. It doesn't go on indefinitely. Repayment isn't required while they're meeting those conditions. Yeah. But it does become due when certain specific events happen. These are typically called maturity events. The most common ones are when your parents sell the home, or when they permanently move out and it's no longer their primary residence. Maybe they move into assisted living or move in with family long term. That triggers repayment. The third scenario, of course, is when the last surviving borrower passes away. At that point, the loan becomes due and payable.
And if they pass away, which is, a difficult but necessary thing to plan for, what's the actual impact on the family finances or on an inheritance for the kids? How does that repayment mechanism work in practice then?
Right. So to put this in perspective regarding the estate, it's really vital to understand that the reverse mortgage balance grows over time. It includes the cash received plus accrued interest and fees. This will reduce the remaining equity in the home. So the net value of the estate, particularly the home's contribution to it, will naturally be lower than if no loan had been taken out.
Okay, that makes sense.
So when your parents pass away and you or other heirs are handling the estate, you generally have a couple of main options regarding the house and the loan. One option is you can choose to pay off the loan balance using your own funds or funds from other parts of the estate and keep the house. Maybe you want to live in it, rent it out, or just keep it in the family. The other main option is to sell the house. The proceeds from the sale would first go to pay off the reverse mortgage debt, the principal, interest, and fees. Any remaining money after the loan is paid off would then go to the estate or the heirs. There's also an important protection with federally insured HECMs. It's a non-recourse loan. This means you, the heirs, will never owe more than the home is worth at the time of sale, even if the loan balance has grown larger than the home's value. The FHA insurance covers the difference.
Oh, that's a really important detail, the non-recourse part. So the debt doesn't spill over onto the heirs personally if the market dips.
Exactly. That's a key protection.
And just as a quick point, the material mentioned there are different kinds of reverse mortgages, correct? It's not just one single product.
Yes, that's right. It's not one size fits all. The most common type, the one people usually hear about, is the federally backed home equity conversion mortgage, the HECM. That one's insured by the Federal Housing Administration, the FHA, which provides those protections we just discussed, like the non-recourse limit.
Okay.
But beyond HECMs, there are also what are called proprietary reverse mortgages. These are offered by private lenders, not government insured. They often cater to homeowners with higher value homes, maybe above the FHA lending limits, and they might have different features or costs. And then sometimes you might find single-purpose reverse mortgages. These are less common, often offered by state or local governments or nonprofits, and they're usually for a specific need, like paying for property taxes or essential home repairs, often targeted at lower-income homeowners. So yeah, different flavors exist.
This brings us to what might be, honestly, the trickiest part for many of our listeners, the emotional side of these conversations. It's totally natural to feel unsettled, maybe even worried if your parents start talking about this, especially if you suspect it's because they're, struggling financially. It can feel like a really heavy topic to even bring up over like Sunday dinner.
Oh, absolutely.
Yeah.
It can be deeply unsettling if you see them grappling with big medical bills or trying to juggle debts on a fixed income, and then a reverse mortgage comes up as a potential fix. What's really interesting here and important is finding that balance between your own emotions as their child, your concerns, maybe your protective instincts, and their financial realities, plus their own desire for independence and control over their lives. It's really a call to, sit down, open a calm dialogue, and try to genuinely understand their full financial picture. And maybe most importantly, understand why they feel they need this loan.
Hmm.
What's the core motivation? Is it maintaining independence? Is it covering a specific, maybe scary, immediate cost? Their reasons are absolutely key to navigating the conversation constructively.
So communication is just paramount. But how do you even start that conversation, especially around such a sensitive, potentially awkward topic? It's not something most families just casually chat about, is it?
No, it really isn't. The source material actually offers some pretty good guidance here. One strong suggestion is inviting a neutral third party, like a trusted financial advisor or even a certified housing counselor, to join the conversation.
Hmm.
This professional can help set realistic expectations for everyone involved. And crucially, they provide an objective, unbiased viewpoint. It helps take some of the emotional charge out of it, depersonalizes it a bit. And remember what we said about the FHA-insured loans, the HECMs? Well, for those, reverse mortgage counseling from an independent, HUD-approved agency is required before the loan can even be finalized.
Ah, right, the mandatory counseling.
Exactly. And here's a really important detail. You, as the adult child or another trusted advisor, can usually attend that mandatory counseling session with your parents. This isn't just allowed, it's often encouraged. It's a fantastic opportunity for everyone to get the same information, ask questions together, and achieve a shared understanding. It's not just a recommendation, it's built into the process for those loans.
That's an incredibly valuable tip, attending that mandatory counseling. It sounds like a really constructive way to be involved and supportive without feeling like you're taking over or dictating. Okay, what about exploring alternatives? Or are there specific red flags that we or our parents should be really vigilant about during this whole process?
Absolutely. Alternatives first. When discussing their financial situation and possible solutions, it's always smart to explore if other options might be a better fit. It really depends on their income, their specific needs, their long-term goals. For instance, if they still have decent income and can handle monthly payments, a traditional home equity loan, or maybe a home equity line of credit, a HECM could be a viable alternative. These often have lower upfront costs than reverse mortgages.
Okay.
It's definitely worth talking with a qualified, unbiased mortgage professional or financial advisor about all the possibilities to compare the cost, the benefits, the risks, and yes, definitely watch out for red flags. A big one is any lender pressuring your parents to take out the loan quickly. High-pressure sales tactics are a major warning sign.
Right, like act now.
Exactly. Or urging them to sign documents they don't fully understand. Any sense of urgency or undue pressure should make you pause immediately and seek independent advice. If a deal sounds too good to be true or overly complex, it probably warrants extra scrutiny. Trust your gut.
So, to really empower our listeners when they have these talks, the source material lays out some specific, crucial questions. Things to encourage your parents to ask any potential lender directly. What are those key questions they should have ready?
Yeah, these questions are designed to cut through the sales pitch and get straight to the essential facts, ensuring your parents are fully informed before they commit to anything. Encourage them to ask things like, first, what are all the upfront costs and fees associated with getting this reverse mortgage loan? This includes origination fees, mortgage insurance premiums for HECMs, appraisal fees, title insurance, recording fees. These can add up significantly and will reduce the net funds available. Get a detailed breakdown.
Okay, total costs. Got it.
Second, what happens if I need to move into a nursing home or leave my home for an extended period, say more than 12 months? This directly addresses that primary residence requirement and how temporary or permanent absences are handled.
Good one.
Third, what financial responsibilities will I still have after I get this reverse mortgage? It's critical to hammer home that they are still responsible for paying property taxes, homeowners insurance, and basic home maintenance. Failing to do these can lead to default and potentially foreclosure, even with a reverse mortgage.
Super important reminder. Taxes and insurance don't go away.
Precisely. And finally, a really powerful question. What are our other options? This prompts the lender to acknowledge alternatives, even if they don't offer them themselves. It reinforces the idea that this isn't the only path and encourages comparison.
So what does this all really mean then? It means asking these direct, almost blunt questions cuts through the jargon, gets past the glossy brochures, and gets right to the core of what your parents absolutely need to know to make a truly informed decision. It really puts them back in the driver's seat of their own financial future, armed with real knowledge. This deep dive has really shown us that a reverse mortgage doesn't have to be this scary, confusing thing. It's a financial tool. And like any tool, really, its effectiveness and whether it's the right tool depends entirely on how it's used, why it's being used, and how well everyone understands it.
Exactly. In the right circumstances, for the right specific financial goal. And crucially, with effective planning, open and honest communication within the family, and ideally, the objective guidance of qualified financial experts or counselors. A reverse mortgage can indeed be a viable way to help your parents fund their retirement needs, manage their estate effectively, and maintain their independence in their own home, which is often so important. It's all about being thoroughly informed and making the best decision for their unique situation rather than letting, myths or maybe unfounded fears dictate their choices.
Well, thank you for joining us on this deep dive into the world of reverse mortgages. We really hope you, our listeners, feel much more prepared now to navigate these important, sometimes difficult family conversations with more clarity and confidence.
And perhaps zooming out for a final thought, this raises an important question for you to consider. Beyond just the immediate dollars and cents, how can understanding these kinds of financial options truly empower a deeper sense of long-term autonomy and peace of mind? Not just for your parents, but for your entire family structure, ensuring their wishes and their independence are genuinely respected as they age.